Perfect. We are now live. So hello to everyone who is watching this from the record. We just started covering the agenda for today. You can see the first 2 points on the screen already. So in the second point, in the second part of this presentation, we will talk about how you can prepare for retirement yourself. So use your own savings to build up a cushion to draw supportive income from after you stop working. So we'll talk about... Sorry, I don't think that was a part of the presentation. If I could ask... wait, can I also... Yes, I can. Perfect. Sorry for that. Weird. At first thought it was a question, but not really. Okay. So we will talk about what investment strategy to use, what to do with the money after you retire. We will talk about payout portfolios and similar things. So some things related to the previous topic of investing, but specifically suited for the goal of retirement, because the logic works somewhat differently there. And afterwards, we will talk about how you can use state-supported products, so second, third pension pillar, to sort of assist you on this journey of saving up for retirement, because there you can often benefit from tax breaks or employer contributions. So it is a good way to, prepare for retirement. But there are many problems with the way second and third pillars function across Europe. And the specific issue or comparison I would like to focus on in this presentation is comparing the existing third pillar pension schemes throughout Europe, because we have data from the research I mentioned, to the novel product or to the new product called Pan-European Personal Pension Product, or PEP, as you can see in the brackets, and the specific solution we as Finax designed, which is called the European Pension. And we will talk about why we think that it is an incredibly good innovation and step in a good direction. So that is the agenda. Let's get straight to it. So what does a typical pension system look like? As I already mentioned, it consists of 3 pillars usually. The first pillar are what you typically imagine under the word pension. We often call them state pensions. This is sort of, you can, I would describe it as a pipeline or something like a pipe through which something flows. This is because there is usually a state institution, such as a social security insurance company or some pension company, that has the right to tax people's incomes. So whenever you work, you have to pay some taxes, which are specifically designated for social security, and a part of that for pensions and for retirement. After these taxes are collected, and that is why I call it a pipeline or a pipe, they are directly redistributed. So let's say in January they collect taxes, and in February they pay out the same money on pensions. So they sort of just redistribute money from the working people to the people who are already retired. This is great as long as you have enough working people, but we're having a crisis related to having enough working people in Europe, and we will talk about it later on. So these are state pensions. They usually, especially in Central Eastern Europe, they usually represent the highest proportion of what people get in retirement, as a percentage of their income. Then there is a second pillar. This can work differently in different countries, depending on where in Europe you are. Typically, they are called so-called occupational pensions. So they are directly tied to your employment, and they usually involve employer contributions. So, for example, in the Netherlands, you have a massive second pillar where you have pension funds, which are either for a specific sector or for the entire country, and employers can select those pension funds for people, and they usually contribute a portion of their income into that pension. So unlike in Slovakia, for example, oftentimes second pillar is where employers contribute. However, you have a second type, more common in Central or Eastern Europe, of second pillar, where it's not financed from employer contributions into pension funds, but where usually a portion of the money that would go into the first pillar, so a portion of the social security tax that I talked about a minute ago, a portion of it goes into a second pillar fund that accumulates in your personal account. That is, for example, how it works in Slovakia. In both instances, it's somehow tied to your occupation and financed from a sort of tax that is on top of your income, either a tax that will go to the first pillar or a tax that employer pays and contributes into the fund. So that is the second pillar. And then we have the third pillar. This is usually called voluntary pension savings. So it's something you should contribute into yourself as a citizen, usually from your own money. So from your net income that you receive into your account, and you can deposit it there. It usually consists of various products. You can have pension funds, you can have some brokerage accounts. For example, in Sweden, these are just brokerage accounts where you can select your own stocks or ETFs or something like that. But the thing is that you have to open it voluntarily and contribute yourself voluntarily. Of course, you are usually incentivized to do so, for example, by being given a tax break if you contribute into this account. And also, usually the profit from this pillar is not taxed over the duration of the investment. So that is about voluntary pension savings. This is how it works. In some countries, such as Slovakia, employers don't contribute into the second pillar, but usually contribute into the third pillar, which is a bit non-standard, but that can also happen. So those are pension systems in Europe. Now let's talk about them in a bigger detail. So let's start by focusing on the first pillar. One of the very important functions of the first pillar is solidarity. And I do not mean this as a critical remark. I think that is a genuinely good social thing that we have this. So in the first pillar, sort of wages or incomes of people who are earning above average wages or who are, let's say, wealthier or earn more, are used to subsidize those who have below average incomes or who don't earn much. So what does that mean? We will illustrate that based on a metric which is called the replacement rate. That sounds technical, but it's really easy. So when you hear the word replacement rate anywhere, what the author of the text means is how much of your income from working age you can get after you retire. So if your replacement rate is, for example, 60%, that means that if you earned 1,000 euros of net income before retiring, then you will have a pension of 600 euros. It will cover 60% of your income, and you will have to reduce your expenses somehow by 40%, right? We can have gross and net replacement rates. Gross are calculated from gross wage. So what percentage of your gross before tax wage you get, and also gross pension before taxes is used. In Slovakia, for example, we don't tax pensions, but this is not a standard abroad. Pensions are often taxable income as well in other countries. So gross takes pensions and incomes before taxes. Net takes everything, after taxes, so what you can count on. So net replacement rate is usually the best metric. It tells you what percentage of the money you used to have you will get after you retire, right? And you can see that the more you earn, the lower percentage you can expect from first pillar. That's the solidarity, right? We pay a higher replacement rate to people who are below average earners than to those who are above average earners. Now, this is good for social stability and for empathy and stuff like that. But it also means that if you are an above average earner, which will be the case for many university educated people, you can't expect much from the first pillar, because the more you earn, the less you can expect to get from the first pillar as a percentage of your income. Of course, you will get a higher pension probably, but you can see that in the EU, on average, the net replacement rate right now is 60% for people who earn 2 times the average income, for example. That means that if you earned 2,000 net income, which would be 2 times the average roughly in Slovakia, for example, you would get 1,200 on your pension and you would have to cut your expenses. That still doesn't sound that drastic. The problem is that this number, this net replacement rate, is only expected to fall. Why? Let's talk a bit about that. This is a story of how we'll match Japan, but not in terms of living standards or anything, but in terms of their age structure. You probably have heard that Japan has an incredible problem with having too many old people and too little young people, and that their economy was sort of stagnating and having troubles, and that their state budget was under a lot of pressure over the last 20 years, let's say. And we are headed in very much the same direction. So these lines show the number of old people or retired people, so the ones we have to take care of, per 100 young people. So young people are those who pay taxes so that we can take care of the old people, right? The more old people there are per 100 young people, the more troubles you have because the less, the more income you need without having more young people to tax, right? So that is an issue because you might find yourself not having enough money to pay out pensions and be unable, for example, to increase them to match inflation. So then the real value of pensions might be decreasing, or you might even need to cut them from time to time. That also happened in some countries. These figures in this slide also illustrate it. So, for example, this is what I already said. The number of people who are working, who are paying taxes per one pensioner who needs income from that taxes is rapidly declining. You can see that it already declined from 3.9 to 2.9 over the last 20 years roughly, and it's expected to decline even more over the next couple of decades. This is also associated with the fact that the median age of the population in the EU has been constantly increasing. We are aging. You have probably heard of that. We are getting older. And it already costs a lot today, with today's replacement rates and with today's pensions. It already costs 10% of the entire EU's GDP. GDP is what we basically earn. It's the money we can generate in the economy. So we spend a tenth of that already on pensions, and we will be needing even more in this space because we will have more old people and less taxes, right? And you might be thinking, wait, can't we borrow? No, we really can't. We have high debt to GDP ratios. European countries already borrowed a lot in the past to finance social welfare, essentially. You might have heard that Europe, compared to, for example, United States or many Asian countries, has more robust social safety networks, right? We take better care of the people who are unemployed, sick, or retired, for example, right? Which isn't bad. But it also means that we borrowed a lot of money and that we don't have much room to borrow even more as the number of old people is increasing. And we have already seen in Europe, very, very close to our region, we have already seen examples of where you can end up if you borrow too much. For example, Greece literally, had so much debt that they caused a lot of troubles to the entire European Union, right, and Eurozone back in 2012, and that was associated with unemployment skyrocketing in Greece, in people being unable to withdraw money from their ATM machines, into rates of homelessness increasing. These are issues that we don't want anyone who we know and care about to experience, and it was a reality just 10 years ago in Greece, and they took many years to recover from it, right? And had to save a lot of money in terms of their state budget. So we cannot really solve this by increasing our debt. We need to find a way to finance pensions from different things than just taxing the people who are working, right? This is the population pyramid, right? The last picture that I want to show you to illustrate this, right? The solid bars show the current, or not current, 2019. That's a couple of years back. But the age structure, right? The more to the top you go, the older the age gets, and so essentially the width of the bars shows how many people in that age category there are. And you can see that currently the most populous generation is still working, right? They are at the top of their productive age. They are in their 40s, 50s. So they pay taxes, they earn incomes, and they can finance retirees. The problem is that you can see that in the ages of 20, 15, 10, the width is much, it's much more narrow than the generations above them. That is because these populous generations didn't have many kids. That was associated with many things. So the birth rates were declining. People were just having fewer kids because it cost a lot of money, and because many more of them wanted to focus on themselves or their careers. Just preferences shifted, and it's also not really cheap to have kids, right? Also in Central and Eastern Europe, this problem was further exacerbated by migration, right? In my country, I even studied abroad, right? I didn't study in the country where I was born. I studied in the Netherlands, and lived there for a couple of years, right? So my story, I came back to this region, but many of my peers don't, right? They study abroad and they settle there because the opportunities and often sort of discrimination against certain groups is lower there. So this even exacerbates the low birth rates, right? Because if young people flee and stay working there, they don't pay taxes in their home country, so their home country has even less income to pay out pensions, right? So these are all the stories that exacerbate the problem. The consequence of this is that replacement rates are expected to fall. So you probably remember the number of roughly 60% on average today in after taxes, right? That is expected to fall. The blue squares are where replacement rates, according to this study of the International Labour Organization, are expected to get by 2070. So that's really in a generation or two, but we are slowly getting there, and you can see that in many countries it's really bad. Notice Poland, notice Latvia, Estonia, notice Croatia, right? In these countries, it's expected to fall to down to 20%, and in many other countries it's expected to be roughly between 20 to 50%, right? Maybe around 40% on average. That is a huge decline in income when you think about it. Imagine that from month to month you would have to cut your expenses by 2/3. It's probably manageable to a certain extent, right? For example, when the kids move out, you don't need as much money to, pay for them in the old age. So you probably don't need to have 100% of your working age income when you're old. But 2/3, that's harsh. That's really harsh with today's prices. So it's good to look for ways to increase this number, to have some supportive income from some financial cushion to be able to support yourself. And that is really what this presentation will be about. We will talk about ways in which you can achieve that. So enough pessimism, because I don't like spreading panic or pessimistic ideas. I just wanted to, show you some numbers to illustrate why we in Finax and why I think this topic is a serious one that deserves a separate webinar, right? Let's now talk about a second question and second part of this presentation. Let's talk about how you can prepare yourself for retirement. We will illustrate it based on numbers from Finax algorithms because they are tangible, right? They illustrate how much you can earn by investing based on historical data. But of course, you can prepare for retirement in any product and with any company and wherever you want, right? So that's not supposed to be an advertisement. It's just for illustration, right? So the first thing that you can see here is an expected development of a stock investment. Now, remember our previous webinar where we talked about investing. There I told you that you can invest usually in bonds and stocks, right? Bonds are less risky, stocks are more risky, but stocks earn more, earn higher expected returns. Bonds usually earn less because they are less risky, right? So what I illustrated there is that if you invest into stock market in general, that means you buy hundreds or thousands of companies from many, many different countries and regions. Then the value of this stock market is expected to grow over the long run because of increases in productivity, technological inventions, increases in educational levels, and similar things. You can come back to that presentation if you want to remind yourself of those principles. However, when there are crises, stock markets go into declines, which can last for a couple of years. I showed you data for that, right? Now, a very important idea of today's presentation is that when you are investing for retirement, a goal that is, for most of us, decades away from us, 20, 30, 40 years if we are starting our careers, maybe 20, 15 if we are closer to our retirement, right? So for most of us, this is a matter of several decades of investing. With this long of an investment horizon, when you will be invested in stocks for a generation or two, there is really no reason to avoid stocks. There is no reason to fear market risk because you have plenty of time whenever an economic crisis strikes to sort of wait for it to recover and give your portfolio enough time to recover. You don't even have to check it for 20 years in many instances, right? You can forget about it. So really for retirement, that is a prime example of a goal for which you should prepare in stocks, right? And this chart that you can see here is just taken from Finax algorithms, which take historical data to sort of model what you can expect when investing for your lifetime. And it models an expected development of an investment where you will be contributing 150 euros monthly, right? So for many people, that can be close to 10% of their salary. If they earn a lower wage, they can contribute, for example, 100 or less, just so it is close to 10, 15, 20% maybe of their salary. Um, and because these people don't need, that much to replace their income, right? And you can see that if you earn the average return of stock markets, which, as I said in the last presentation, is 7, 8, sometimes 10 or 12% per year on average, depending on the exact decade or decades that you manage to get. This will grow to a massive amount. This is because of compound interest and similar logics, but the thing is that for many people, it's even counterintuitive to how large amounts this can grow if you invest for many, many years. You can see at the bottom that this is really investing for decades. But you can see that this grows to roughly 300,000 euros. No, not yet. This is not the European pension product. This is only an ETF portfolio. We will get to the European pension product later on in this presentation. Don't worry, I will notify you of that pretty much. This is just investing into ETFs on your own terms. You can withdraw this money anytime, and so right. So this is just an ETF portfolio that grows to this large amount, right? And already with that, if you just split that among 20 years, for example, you get a pretty decent pension. However, there is a second trick that I would like to tell you, and that is very often underestimated in European pension systems, and that is so-called payout portfolios. So think about it this way. According to current, if you retire today, you would be expected to live in Slovakia almost 2 decades in retirement. If you manage to live until 65, you are expected to live for 19 point something years in retirement. In many other countries, it's even slightly longer. And by the time we retire, who are sitting here at this presentation, we might be expected to live even more because of advances in medicine. For example, 25 or even 30 years, right? So you will spend a lot of time in retirement if you manage to survive by 65, right? Despite our tendency to underestimate this, right? That is an insane amount of time, and is a real pity to hold all the money that you managed to save up in your productive years in your pillow or under your mattress somewhere and let inflation erode its value for such a long time, right? Because 20 years, that's still, a lot of time to recover from potential declines in stock markets or something like that. So what is usually recommended, and we didn't come up with this, that is from financial literature, usually originated from the US, where people thought about this more, is after you retire, keep your money still invested so that it can still at least match inflation, maybe earn some extra return on top of inflation. Not in stocks, because you sort of don't want to risk too sharp declines and having to, reduce your income due to that. But let's say a balanced portfolios between stocks and bonds. Let's say 60-40, 60% stocks, 40% bonds. That is usually the recommended payout portfolio that you will find in literature related to, preparing for retirement on your own. So let's say a 60% stock, 40% bond portfolio, where you will keep the money invested for 20 more years, and each month you will just sell off a portion of the investment and draw income from that. This will allow you to earn some extra return, and that will allow you to have a higher expected pension because you will earn some extra return while you are retired, right? And you will be able to either have higher pension or leave a higher inheritance for your kids, for example, if you want, right? And even if declines come, economic crises hit, you still have enough time to wait for it to recover, because when you are just retired, when you're 3 years into your retirement, you will be drawing up the bottom, let's say, quarter of your savings in maybe 15 years, in maybe 13 years, right? So if the portfolio declines by 15%, that really won't hit your ability to draw income in normal regime and wait for the recovery, right? So you can afford some risk, maybe not 100% stocks, but mixed portfolio is usually okay. And you can see that if you just switch the 318,000 saved on the previous slide, so you can see that the average expected result is roughly 318, right? And we deposit it as a one-off investment, you can see it in the bottom left half, into this payout portfolio, we are expected to be able to draw 1,200 as income and still keep a lot of that money for our kids, for example, as inheritance. So that's without any state pension, a pretty decent result, right? 1,200, that's a good pension, but you have to combine this with the fact that you will have the right to draw some income from state pensions. So really, this combined from not an amount that seems super unrealistic, right? 150 per month based on just historical data and appreciation of stock markets, you can get 1,200 per month. The only catch is that you have to do it for an extremely, extremely long period of time and be really disciplined and safe, right? The longer you do it, the less money you probably need, right? So this is again a hypothetical example where you would be earning the 8% per year. So that's the average long run historical performance of the stock market that I showed you in the previous presentation. And it sort of shows you how much you would need to save up 200,000 euros by the time you retire. So by 65, that is the official retirement age in many countries, not in every, but let's say until 65, depending on the age when you are starting. So for example, if you can see that if you are 25 or if you are in your 30s, you don't even have to save more than 100 or only slightly more than 100 euros. So that doesn't sound that unrealistic, right? It's not that you have to be a millionaire or that you have to be an executive director of a big company to achieve this. You have to admit that although it is not the most comfortable thing, it is realistic for many common people like us, right? And the older you get, then you need more money. Then it's getting more unrealistic. So the worst thing you can do is start late, right? It's good to start as early as possible if you want to utilize this, right? As I already said, this is a fun fact. If you manage to earn 8% per year, then the investment is expected to double in value roughly every 6 to 9 years. But I would take this with a grain of salt if I were you, because stock markets never grow, by 8% every year. It's just a very long run average number, but they grow very wildly, right? They sometimes grow by 25% in one year, then they earn 0.5% in the second year, and then they decline by 15% in the third year. So it's very unstable, right? They go up and down, and 8% is just the long run average number when you take 25 years and compute, on average per year, what was the average performance if you average the 25 and the negative 13 and the 0.5 that I just talked about in the individual years, right? So, but starting early matters. As I already said in the previous presentation, if you ever prepare for retirement yourself, we think that the best tool to achieve that for long run investing in stock markets are ETFs. This is because they have higher returns because they do the passive investing we talked about in the past webinar. So they just copy the value of stock markets or of large regions. They don't have their portfolio managers who try to look at charts and think and predict which companies will be successful, which usually turns out to be likely to succeed or not be successful if you do this active investing. So it's usually good to just hold the stock markets for very long periods of times, and ETFs are designed for that goal, right? They are liquid, so you can withdraw from them and sell off the investment at any time. Compared to, for example, real estate, many people, especially in Central European region, consider real estate to be the best form of investment. But then it's oftentimes much harder to get your money, right? And especially if interest rates are rising and not many people want to buy because it's too expensive to get a mortgage, then you might be unable to sell your real estate at a reasonable price for even months or years, right? So people often underestimate this need for liquidity, especially if this is some sort of safety cushion where you can, later on when you are older, use it as supportive income when you're, for example, unable to work anymore, right? They have diversified risk. So since they contain hundreds or even thousands of companies, whenever something happens to one of those companies, you probably won't even feel it on that portfolio. So just the fact that there is an accident in a factory in a specific company, which was random, but could hurt you if you only held the stocks of that company, these random events won't be that much of a threat to you because you hold a lot of eggs in your basket, right? because it's a basket of many firms. They also have low fees because, as I said, they don't have their expensive, sophisticated portfolio managers. They just look at what is included in a specific index and copy that. For a better explanation of all these terms, please refer to the past webinar. I explained that there with examples. And very important when investing for retirement, tax regime. In many countries, ETFs have very attractive tax incentives. In Slovakia, Czechia, or Croatia, after holding them for a couple of years, you will get a full waiver on your profit taxes. That means you don't have to pay anything. If you save for the long run for retirement, most of the value of your account will eventually be returns rather than what you deposited there, especially if you've invested for 25 or 30 years, right? Because of that is just how the mathematics of it works, right? So tax on profits can be giant if you are investing for retirements. If you were holding it in an investment where you have to tax the entire profit, you would probably be saying goodbye to even a fifth of your account. So that is if you manage to save 200,000 or 300,000, as we said, which should be the goal if you really do it throughout your productive life, then that can be tens of thousands of euros that you would have to say goodbye to unless you select an instrument that has tax incentives, right? And ETFs, often even if they are not a part of second or third pillar, in many countries carry tax incentives. That is why they are an amazing tool for long-run savings, where return will represent a very major portion of your account value in the end, right? Related to the payout portfolios that I mentioned before, is this 4% rule. This 4% rule is a simple rule that helps you sort of determine how much you need to save up if you want a specific income, right? So many times people are asking, what is enough, right? What is the target amount I should be striving for? When can I afford to retire comfortably? There was this study called Trinity Study conducted in Texas by three economics professors who sort of tested a lot of historical developments and a lot of potential future developments. And they found out that if you take an amount of money and deposit it in a 60% stock, 40% bond portfolio, so that is just the payout portfolio I talked about, right? Then you can withdraw 4% of the total amount in that portfolio, of the total amount you've saved up. So you can withdraw 4% of that in the first year, the entire year. So then you divide it by 12, and that is your monthly income, right? You can withdraw 4% of it in the first year, and then each subsequent year increase the amount withdrawn a year by 2%, so that you match inflation, because everyone probably wants their pension income to rise by inflation, because 100 euros today is worth much more than it will be worth in 20 years, right? It won't buy much in 20 years. So you want your pension income to grow by inflation. So you can do this. You can increase your annual pension income by 2%. And there is a very, very high probability then that this money in the 60 to 40 portfolio will last for 30 years. So it will be enough to cover your expenses and increase them, increase the amount withdrawn for 30 years, right? For most of us, that means the ability to live from 60 until we die, right? That is the 4% rule for payout portfolios. This means that if you want to find out, if you sort of do the math and readjust the equations, then you find out that if you want to find out how much you need to save up in order to draw some specific monthly income, you have to multiply the total annual income you want in the first year by 25. And that is the total amount you need to save up, because then, the annual income will be 4% of the total amount that you save up. Not to be vague, let's look at that, right? So for example, if your annual costs are 18,000, this means that per month you need 1,500 euros to survive and live comfortably as you wish, right? You want 1,500 euros from your money, then you need to save up 450,000 euros and deposit them into the 60 to 40 portfolio. And then you can each year increase this 1,500 by 2% and live off that, right? Of course, that might sound like a lot of money, but many of us won't need really 1,500 euros because we will have some extra income from state pension. So for many people, it might, for example, be the first case in the first row, right? When you if you save up 150,000, which, as I showed you, should be possible if you do it throughout your productive life with less than 150 euros, right? Then you can use these 150,000 euros to draw income of 500 euros a month, because that's 6,000 a year, right? So 500 euros a month for the next 30 years, and even increase that with inflation, right? So you can use this 4% rule, multiply yearly costs by 25 to get the amount of money that should be saved up. And many people use this concept to sort of develop this movement that is called FIRE. There are many books about it. The movement is called it's an abbreviation for Financial Independence, Retire Early. These are sort of freaks, but for many of you it might be interesting, right? I'm telling freaks because they are trying to achieve a goal that to many people in our region might seem completely impossible, and that is to retire on their own, to literally not need any state income and have enough of their own money to be able to live off their wealth, right? So to save up and to retire whenever they want. Their goal then is usually to retire younger than the official retirement age. So retire at 50 instead of 65, for example, because they are already retired and want to focus on other things, right? So that is the goal of that movement. And they created this table when they sort of computed how much percent of your income you need to save in order to be able to fully live only off your own money and not be dependent on state at all. And you can see that the higher percentage of your income you are able to save, the sooner you will be able to retire and become financially free. The reason why I'm showing this is that I don't think many of us will even want to save that much or be able. And I'm not saying that that should be the goal. What I wanted to illustrate is that look at for example, 20% of income. That says that you should be able to reach FIRE roughly in 37 years. For many people, that's how much we will work until 65, right? That is roughly our productive age. So if you manage to save 20% of your income, you will be able to have a full replacement of your working age income to be able to retire and have the same income as you had before in 37 years, right? So for many people, if we somehow manage to save at least 20%, then by 65, we don't even have to rely on the state at all because we will have so much money that we can live off it ourselves. Decrease it slightly, make it 15 or 10%, and then you will have essentially the same income when you combine your own savings with what you will get from the state, right? So oftentimes 10 to 15, just starting with that, might optically not seem as much when you think about it. You might be, oh, okay, I'll send 100 euros. I'll send 150 euros. What can that make? Can that make a difference? If you do that for 30, 40 years throughout your productive age, that will matter because you will definitely be rich and have no troubles not having enough money when you are in retirement. The trick is to do it for long enough, right? So, the goal of this table wasn't really to persuade you to try to retire when you are 40. Of course, if you have enough money, go for it. But to sort of illustrate to you that the way the mathematics works, it is often enough to save 10 to 20 to have a really, really high standard of living when you are old, right? And then, the people who are trying to achieve FIRE, they are trying to control their expenses so that at some point their income from their wealth exceeds those expenses and covers it, and they are able to retire at a younger age, right? If you are interested in this movement, then read some books about it. There are books such as Playing with FIRE or Your Money or Your Life is probably the most famous one by Vicky Robin. Those are people who sort of started this movement, and they have a lot of tricks on how they lived, how they cut expenses, and so on. It's interesting read. If you are interested in this movement, go for it and order those books. They are great, and they are written in a very nice language. They are easy to read, and it's sort of good literature. So if you want, go for it. Okay. Now to the last point of our presentation. I spoke about saving yourself, right? About the investment strategies used. Oftentimes, states try to assist us with this, right? So we don't just have to save in ETFs in our own brokerage account and from our own money. There are state pension pillars which have some tax incentives and are supposed to make it a bit easier and motivate us to do this. And however, the problem is that they don't function perfectly. And in the last part of this presentation, I wanted to compare the existing third pillar products, so voluntary pension saving schemes in Europe, with this rapid or with this innovation that is called the Pan-European Personal Pension Product, or European Pension, or abbreviated as PEP. So let's first introduce what this idea of the European pension is as an innovation. You can imagine it as a Europe-wide third pillar. It is a third pillar product which functions very similarly to normal third pillar in most countries, but it exists across the entire Europe. That means that you can get the same legislative or very similar legislative conditions in most countries, and that it's transferable. That means that if you move at some point in your life from Poland to Germany, you can just take your pension savings and transfer them from a provider in Germany to in Poland to a provider in Germany at no tax, at no charge, right? This is the crux of the product. So really, for people who are still, let's say, younger and don't know where they will settle, or people who want to start their career in a place where it's easier to move money and then maybe move back home, or for people who work for multinational corporations and move around a lot, this is a very desirable feature. However, I think there are more desirable features even than this portability. That's a good side benefit. But the main thing is that the European legislation defines some very strict requirements, and they will be very important because in many of these requirements, national third pillar products are lacking and are sort of having deficits, right? So European legislation defines return requirements. So they require you, if you want to certify the product, they require you to show that in many historical periods and in many possible future developments, there are statistical models for this, you would beat inflation. This is the problem with many third pillars, because I bet that there are some people who have experience with third pillar and know that many of those funds don't even match inflation. This has been a long-term problem with European pension funds. They just earned very, very low returns, often barely matching inflation, or even not really earning even those 2%, right? So European legislation, if you want to put the PEP sticker on your product, you have to show them the statistical models that you are likely to beat inflation by a solid margin, right? They also return how you manage risk, define how you manage risk. They have a cap on fees, so you cannot exceed 1% per year. Many European pension funds are much more expensive, and I will show you data for that. And they also define payout options, so the forms in which you have to be able to draw your income, right? So this is the innovation. The question is, why? Why did the European Union feel the need to create this pension product? Well, the problem is that I would say twofold. The first is that European Union, of course, wants to integrate its markets, and people today are much more mobile than they were before, right? We are often not tied to one place, but we, let's say, study and start working in one place. We move across countries. There are companies which are present in many countries, and you might be required to move between their branches across your life. It's easier to sort of move around, right? And not being able to take your pension savings with you might be a reason to discourage you from even starting to use these products, starting to save for retirement in a tax-advantaged scheme, right? That is bad, and they wanted to motivate people and make it easier for these kind of people to save. However, there are some other advantages, especially compared to national pension pillars, right? The one thing is that in many national pension products, they are just not transparent and simple enough to understand, right? Not only you don't have much information about how it works, but oftentimes the pension fund providers themselves are not very keen on disclosing what kind of fees you pay there, what the investment is composed of. PEP has very strict conditions on what you have to disclose to the clients, what kind of documents you have to prepare, sort of for them to understand what the product is about and how much it costs, mainly because hidden fees are often a problem in pension savings, right? The fourth row, when you look at the legislative stability, for me, this is the single most important issue, right? What I mean by this. National pension pillars are often even good products. For example, second pillar. Second pillar often is super cheap and often has available index funds, which are a good investment strategy, right? The problem is that they are very easy to meddle with if you are a politician. And since, as I said, pension savings are not really a thing that for many people are imaginable, right? things such as pensions, current or healthcare, are sort of easier to sell to voters than we can't abolish this pension pillar because you won't have enough money in 30 years. That's usually not the major topic in elections, right? So oftentimes second or third pillar become an easy target for governments that want more money for today's spending to keep their popularity, right? And we have seen very harmful interventions into the functioning of second and third pillars in several countries. For example, in Hungary, you might have heard that in the media it's often sold as nationalization. It wasn't a full-on nationalization, but Viktor Orban essentially managed to push people to withdraw money from there and move it to and rely more on the first pillar, which means that they pay more of that money into the state system and the state has more money for current spending. In Slovakia, for example, it is very popular to decrease the maximum portion of your income that you can invest in the second pillar, right? So in the past, it used to be 9% of the gross wage. Now it's capped at 4, and it's supposed to decline even more, right? In other countries, for example, we saw examples of politicians forcing the pension fund managers to invest into government bonds. That helps finance state projects. It makes government debt cheaper, of course, great for politicians. But as you know, bonds are not a good investment for long run investing because bonds earn much less than stocks and they have a much lower likelihood to beat inflation, right? So this also isn't a good step when you are supposed to save for several decades, right? So it's very easy to meddle with pension products, and governments often do that. PEP, under the European legislation, Europe, sometimes it's criticized for being technocratic and sometimes legitimately, but here, the fact that they are more isolated from the pressures for current spending or from pressures of being popular among, ordinary voters might be an advantage because they face lower pressures to meddle with this product and somehow decrease the amount people are contributing into it because it won't help them be more popular or get more money for themselves if people are paying more into the first pillar, for example. That wouldn't benefit the bureaucrats in the EU. So it's very stable when it comes to legislative pressures. And then also, as I said, requirements on performance and caps on fees help keep this product cheap and have enough in stocks to earn high returns. What I mean by this is, and now I will show to you a graph that was a result of the research I talked about. So I led this research group where we examined third pillar schemes across the European Union and with a very specific focus to how much they earned over the last 10 years and how much they cost, right? So in the bottom line, you can see the fees. The more to the right you are, the cheaper the product is. The more to the left you are, the more expensive the product is. You can see that although there are some countries which have very cheap third pillar products, such as the Netherlands, Belgium, Austria, there are many who have very, very expensive products exceeding 1%, 1.5%, even reaching 2% per year in some countries. So many countries have really expensive third pillar products, right? But the highest problem, the biggest problem, the fees, if you earn a lot of return, the fees aren't that much of a problem, right? The problem is that most third pillar schemes in Europe earn abysmal returns. They aren't even able to match inflation oftentimes. The return in the left is already adjusted for inflation. So we already subtracted the inflation in the period from the beginning of 2012 to the end of 2021, right? And you can see that while some countries such as Ireland and Sweden have well-performing pension products, they oftentimes are close to 1%, 2%, 0. They don't offer much actual appreciation of your wealth, right? Compare that with the Finax bubble, and that is the solution we designed, right? So that is as you might have heard, or as I said, essentially, Finax became the first provider of the pan-European personal pension product in Europe. We based the solution on a simple ETF portfolio that just replicates the composition of the global stock market, and we applied a fee of 0.72%, including VAT, per year, right? So it's less than 1%. It's even below the cap that the European Union mentioned or defined, right? Since these ETFs and these indices that they replicate have existed for a long period, we are able to model back how this portfolio would have behaved for the period 2012 to 2021, the same period for which we found return data for these third pillar schemes, right? We can just look back at the actual prices these ETFs had. We can subtract from this the fee that would be applied by Finax, and sort of get the number, get an idea of this number. And you can see that in terms of return, this solution based on ETFs beats all the available third pillar products by a wide margin. And the reason is twofold. One is fees. So as I said, the pan-European personal pension product by Finax has a fee of 0.72% per year. In this graph, this is not our research. This is a research composed by a company called Better Finance, which examines pension products across Europe on a regular basis and has very strong data on it. And you can see the development of the average, or not average, median fees in the third pillar. That is the light blue line on the top, right? Median means that half of the third pillar products in Europe had a lower fee, and exact half had a higher fee, right? And you can see that the median fluctuates somewhere between 1% and 2% over most of the period, right? But right now, the median is above 1%. It's maybe 1.2, 1.25, 1.3, right? That means that half of the third pillar products in Europe have a higher fee than 1.3, compared that to 0.72 in pan-European personal pension product, right? It's cheaper. That already allows you to earn more money. But and this is the biggest, by far the biggest problem with European pensions, they have too much money in bonds. It's just insane, right? As I said, bonds make sense many times. That was in the last presentation. When you are investing for a short period of time, when you need to be cautious, when you need to renovate your house in 3 or 4 years, then it makes sense to be cautious and to have bonds in your portfolios and go for it. But when you are investing for 30 years throughout your life, it makes no sense to have most of your money in bonds or in cash instruments, right? And cash deposits. And the problem with pension funds in most European countries is that they are just cautious for no reason. They are so afraid of market risk that they hold most of their money in bonds and less than half of their money in many cases, as you can see in the chart, in stocks, right? And that deprives them of the long run return derived from the fact that the profitability and that the productivity of the global economy is increasing, all the mechanisms that I talked about in the last presentation, right? And that usually this bad allocation combined with high fees is usually the reason why third pillar funds are barely able to earn the 2% to cover inflation and don't really multiply the wealth in real terms, right? And that is the problem that we are facing, and that wouldn't happen if these funds had the same requirements as pan-European personal pension products, right? If they also had to show past data and prove that in the past they would beat inflation, because many of them would be unable to do so because they didn't beat inflation in the past, or they barely matched it, right? And these funds wouldn't then be able to be certified as PEPs. But in national legislation, this often is not something that is stressed or that is considered important by politicians, and therefore these compositions that are unlikely to beat inflation can and are allowed to exist and hold people's savings for decades, even for longer, right? Luckily, there is now the option of PEP, and in many countries, the legislation even allowed people to transfer third pillar savings into PEP. That means if they had accumulated some savings in their third pillar, they have a couple of thousands or tens of thousands saved up there, they can transfer it into PEP free of charge, right? Not all the countries allowed this. Most didn't, as you can see, but Poland, Finland, France, Netherlands even allowed this, and there will be more pressure in the future to allow more transfers even in the future. So, for example, in Poland, where the third pillar performance has been really bad over the past 10 years, we had a lot of people having interest in transferring the savings, right? So that is the thing. But even if PEP is not your preferred solution, then at least, and this is the last very important piece of advice I would stress in this presentation, if you are expected to use the second or the third pillar for decades, for a very long period, because you know you are now 30 or 35 and the retirement age is 65, there is no reason to avoid stocks, right? So if this is available, select an index fund or select a stock fund. Don't keep your money in bond or mixed funds because there you will just be losing money, right? It's very important not to hold most of your money in bonds when you are young, right? Or when you are still uh, when you still have a lot of years of investing in front of you, right? So even if you don't choose PEP, be sure to set up your investment strategy so that it is built on stock market. So ideally indexes or stock investments, right? Ideally index funds, which are available in many countries. And I know because I've been giving these presentations for some time, I know that this is not always the default option. I talked to this one guy from HB Reavis who told me that in his country the default was bonds. So if you open an account as a 25-year-old, you would automatically be investing in bonds, and you had to do the research yourself and go to the website and change it to index or stock index investments. So this is important, right? Not to deprive yourself of money, and of course check the fee. If there is a cheaper option as a pension fund, then definitely go for it. That would be all for the content that I have prepared in advance. I have prepared this short conclusion slide to help you organize the ideas I talked about. So the main thing you should be aiming for is increasing the replacement rate, right? So the income or the portion of your working age income that you can get after retiring. Sadly, due to unfavorable demography in most European countries, you are likely to get roughly 30 to 40% of your income after taxes from state pension. But you can count on that money. It will be a lot of help, right? In future, I like to say that probably pensions will be more like a social insurance, right? They will be used to cover the basic needs, to cover housing, to cover food, maybe essential clothing, but they will not manage to get you a decent standard of living. That money won't be for traveling or for spending free time with your grandkids and buying presents to them and similar things, right? Or buying some more expensive things. That will be really an insurance against poverty. So it's good to get the rest or increase this replacement rate by having some of your own savings, whether that is on your own in ETFs under your own terms, or whether that is in good third pillar products and good second pillar products with low fees, tax advantages, and all the other things, right? Ideally, I would suggest aiming for roughly 50 to 70% of the current net income, because as I said, there's no need to be overly greedy, right, or overly scared. None of us will need the entire income that we earned over the working age after we retire, because if you have a family and the kids move out and start earning their own money, your expenses will decline rapidly, probably. From talking to my parents, I know that this is true, that kids consume up a lot of money. Also, afterwards, you probably don't need to live in such a large flat or such a large house. You might be able to move to a smaller place and get some of the money from the sale of the previous place, for example. So there's no need to be greedy, but it's good to aim for 50 to 70% and have a reasonable plan to achieve that goal, right? The best way you can secure additional income is through long-term investing. So don't speculate, don't look for shortcuts, don't try to buy the next Bitcoin or Nvidia, don't borrow money to invest. All these things are likely to get you burnt and just lose you money and prolong this journey. If you want to have a solution that is simple, requires a lot of patience, so it's no shortcut, but has a high likelihood of working, right? That's the main thing. It has a high likelihood of working roughly as expected. Then just invest for the long term. Invest for several decades. Invest in cheap index funds, for example, in index ETFs, and combine that with good subsidized pension products. So combine that with good second pillar, combine that with pan-European personal pension product, and you should be able to achieve that. Also, one side note, it's also good to repay all your debt by the time you retire. To eliminate the need, for example, when you already have a smaller income and something happens, an emergency, and you are unable to make repayments or unable to sort of finance the emergency. Then without repaid debt, you might need to consolidate it. You might need to take out extra debt sort of to cover just your fixed expenses on repayments. So it's good to also aim for repaying debt. So long-term investing combined with repaying all your debt by the time you retire and having 50 to 70% replacement rate after taxes should be great. And the good news, based on the math I showed you, this is not a goal that is reserved for super wealthy, right? This is not a goal that is only achievable if you own a very successful business or if you are in a very high executive position. This is achievable for normal people as well, but it requires some discomfort over life. That's for sure. So that's all for that. So that was supposed to be like motivational to to wrap it up. That's all for my content. If you have any questions related to what I was saying or related to any slide that I was presenting, I will be happy to answer them. So feel free to ask them or post them via Slido or write them into the chat.
If I may, I have one question.
Yeah, of course.
Can you please go back to the slide number 21, the comparison of PEP scheme with third pillar?
You mean this?
I do not see it. Wait a minute. Okay, I see it now. Okay, so please correct me if I'm wrong, if I understood it correctly. So this figure is comparing state-owned pension schemes, third pillar, with the PEP, right?
Yes, and not with the PEP in general, with the specific Finax PEP, right? Because
Finax
PEP
setup. Okay.
Yeah.
And I would like to ask, so third pillar, as I understand it, is one option how to invest for retirement. But there is also, there are private options. You can, as you mentioned, invest into ETF index funds and use maybe some broker, maybe some company, whatever. I would call it private investing options. Maybe there is a better name for it. I think sometimes they call it fourth pillar. I don't know. So I just want to ask, so can you summarize the reason why should somebody, and I'm from Slovakia, so it can be different in different countries, but why should somebody, for example, in Slovakia, invest into the third pillar, specifically into Finax PEP, versus these private investment options and, for example, investing into ETFs or something similar? So can you compare these two options and why should somebody choose one over another?
Yes, of course. That is a great question. We often get this question. I will say advantages and disadvantages of both options. So let's start by the private, right? So I would call that preparing self-preparation, right? You invest into your own ETFs on your own terms. Then usually the biggest advantage is flexibility, right? There is no retirement age that is limiting you. In third pillar, in PEP, you will usually be unable to withdraw your money before the official state retirement age because the state wants to ensure that this is money reserved for retirement. If it's your own money, you can use it for anything you please. So is there a larger purchase that you want to finance and you are certain that you will still have enough money left for retirement, then you can finance a renovation or something like that, or some emergency for it, or a portion of kids' studies or whatever, right? Whatever happens, you can use it. Also, if you want to partially retire early, for example. So for some of my colleagues, this was, they agreed with their partner that as they were older, they wanted to switch to a part-time work so that they could spend more time with their kids and start drawing already some supportive income from the money they've saved up before the official retirement age. You can do this. You are flexible. You can withdraw the money at any time you please. With third pillar and PEP, the disadvantage is that you are tied until the official retirement age and cannot touch the money before, right? So this is really on your own terms. With PEP or third pillar, in general, you have lower flexibility, but usually this is in exchange for attractive tax incentives and the ability of your employer to contribute money, right? So in some countries, not so much in Slovakia, I would say, because their ETFs are anyway tax exempt. But say, take the example of Poland, where you don't have any tax advantage on ETFs as such. You just cannot hold it for a couple of years and get rid of the profit tax. There, PEP is a way to defer taxation, right? It's a way not to pay that much of a tax on profits, right? And in many other countries, this can also serve as a way to decrease your tax burden. In Slovakia, for example, if you contribute into PEP, you get an extra tax advantage. You can deduct some money from your income tax base. I think it's on up to 180 euros per year, right? So you can pay lower income tax in each year in which you contribute. Of course, this is not much, but it matters. But for example, in Slovakia, a big argument is that employers can contribute into PEP. Many companies are already doing it, right? And they can already get some tax advantages on the company side tied to that, right? So they have some incentives to contribute to PEP and get their own tax shields, derive them from it, right? Companies probably won't contribute into your personal ETF account, specifically because they don't have the flexibility limit, right? They cannot be sure that you don't use it to buy a new car or something. Companies usually want a guarantee that you will that if they spend this money on this benefit, you will use it on retirement, right? That is why they usually contribute into PEP or third pillar, but they also don't have the extra tax advantages. For example, ability to contribute from the gross wage and pay no social security contributions on that amount, right? So the ability to get employer contributions on top is often a big reason to or big advantage of third pillar or PEP. In Slovakia, the legislation is still sort of shaky because the tax break for employer isn't really the same for third pillar and PEP. But there have been a lot of improvements, and employers are now able to get some benefits when they contribute, right? So I would say that the main thing I would personally think about is that advantage of saving on your own is flexibility. And advantage of saving in PEP or third pillar are taxes on your personal level and ability to get employer contributions if you negotiate well. So that would be the main comparison for me.
Okay, thank you very much. And maybe do you have any comparison between these private options, private investment options, and third pillar option? I mean, comparison of return versus fees.
Yeah, it depends because if you invest into ETFs on your own, you can mix up the ETFs in the way you please. But in general, it will be very similar to this because think of it this way: Finax PEP.
You can compare the same portfolio structure, for example.
Yeah. Finax PEP is just a portfolio composed of ETFs replicating global stock markets. You have the US, Europe, emerging markets there. It's just a global equity portfolio built on cheap ETFs, right? Of course, you have to apply the Finax fee on top of it. But since the difference since the fee is just 0.72, it wouldn't be that much. I would say it would be very similar to this comparison if you take a global ETF portfolio. So it would be very close to 12%. Slightly more than 11.7% and slightly more to the right because it would probably be slightly cheaper. But it would be very similar. It would be around 12%. Similar
and the return,
what you can see here,
which we see in the graph, 11.7% is just for 2012 to 2021, right?
Yes. So it's a very lucky decade. It's a very lucky decade. That's the usually if we took and we don't have data for third pillar there, but if we took 2001 to 2010, it would be much lower. That was an unlucky decade. 2012 to 2021, that was a super strong decade, right? That's what I talked about in the last webinar, right? Strong decades are changed for weaker decades. That's why you should invest for several decades to average it out. But yeah.
Okay, thank you very much.
In that period, the stock market just earned around 12% per year. So even private options would be very, very similar to 12. Okay, thank you very much for the question. Is there anything else you would like to know? Yes, of course. Interactive brokers to Finax or vice versa. Of course, this is possible. If you do it from a broker to Finax, you even get a discount. This is called an investment transfer discount. You can find the information on our website. We've been offering this essentially since the creation of the company. So if you document a transfer from a different investment option, and that can be anything, that can be brokerage account, that can be a mutual fund, that can be a real estate fund, that can be selling your investment property, whatever. If you document it, so send us some document confirming the withdrawal of money, within a month before you invested into Finax, you will get 50% off of your management fee in Finax for 2 years. So essentially, you will be paying only half of the fee on the deposited transferred amount, right? Than normal. So not only this is possible, it's encouraged via discounts. And you can also do it vice versa, right? The only problem is that if you live in Slovakia or Czechia, Croatia, if you didn't invest for the period needed for a tax break, then you would and withdrew it to transfer it elsewhere, you might be needed to pay a tax on profit, right? But if you are already in the tax exempt period, for example, you've invested for longer than 1 year in Slovakia, or for longer than 2 years in Croatia, or longer than 3 years in Czechia, after this period, ETF's profits are free of tax. Then you just withdraw the money. There is no fee for withdrawals in Finax. There won't be any tax associated, and you deposit it elsewhere, right? But you will have to do it through like a withdrawal order and then redeposit it elsewhere, right? So yes, it's possible. No fees for that. And if you do it the way from other products or interactive brokers to Finax, you will get a nice discount on top of that. Thank you for the question. Anything else you would like to know? If not, or if you are sort of afraid to ask in front of everyone, you can always message me on my LinkedIn or email me on my email. The front slide contain my information, Szymon Pekar at finax.eu. Or you can even mail the entire company at client@finax.eu. My colleagues, they regularly answer questions of people about personal finance. And if it's a very good question, then it might even get included in the podcast, if you agree, where we answer client questions. So if anything else comes to your mind later on that you would like to share or ask, feel free to reach out. We are here to educate and help. And so if there are no further questions that you have about this, I hope you enjoyed the series of webinars. Thank you very much for joining, especially to those who managed to join for all three of them. And I hope you learned something. I hope you got some inspiration to maybe take some steps to change the way you handle your personal finance. And I wish you a best of luck with your financial goals. Thank you very much for joining, and enjoy the rest of your day.
Thank you.
Thank you. You're welcome. Thank you for joining.